The idea of passive income is not a new one, but it's really blown up in popularity, especially recently. The internet and online investment advice has really grown a tremendous amount in just the past few years. And more people have realized that you can make a lot of money doing activities you're not actively involved in. Sometimes it can be a little hard to describe what exactly passive income is, but there are a couple key takeaways, and technically there are specific rules for what the IRS considers material participation. And the understanding of passive income is obviously important because when you go to file your taxes, there are certain things you can do, like claim a passive loss against income generated from passive activities. But the general idea of passive income, making money while you're not actively involved, is really appealing because wouldn't it be nice to have the money for rent or housing payments, things like that, without having to go to a job constantly? Obviously, if you stop working at your job, you're not going to get paid for that. But if you were to have some sort of investment that pays dividends, things like that, as long as you hold that position, you will make money passively. And this whole idea of dividend investing, things like that, has really blown up recently. It's really not uncommon to see lists like this: 25 high dividend stocks and how to invest in them. Dividend investing is popular. And there's this whole concept of the snowball, something that Warren Buffett really popularized. As you accumulate money, it gets easier to make more money, which is true. When you have a lot of upfront capital, assuming you make good or reasonable investments, you can use that capital to your advantage. And dividend investing is a very conservative way to approach this, where you start out with a certain amount of money, you try to make money off growth, but you also get paid in dividends that you can reinvest into your account. The main issue is that you don't make a tremendous amount of money off of just dividends. Now, while technically you do have some risk with holding an asset, if you're holding a solid stock, generally you will see growth over the long term, but it's going to depend on the company's business model, other things like that. Probably one of the most famous examples is GE, but we'll get into that later. There are certain stocks called Dividend Aristocrats, and the rules to join the leagues of the Dividend Aristocrats are as follows. They should be a member of the S&P 500, meaning they are a large US-based company, and they need to pay dividends consecutively for 25 years, but not just pay them, they have to continue to raise their dividends for a minimum of 25 straight years as well. And there's a couple other attributes that play into it. Companies must be worth at least $3 billion at the time of each quarterly rebalancing. Average daily volume of 5 million in transactions for every trailing 3-month period at every quarter rebalancing date. Again, a lot of rules, other stuff like that. But generally, this is just including large, stable companies based in the United States that have consistently doled out dividends and increased their dividends. These are very reliable investment platforms if you want dividend returns. And we can see there are a fair number of these companies, but if you look at the actual dividend rates for these companies, we see on the low end, we get little more than 1%. On the higher end, they might exceed 4%. Although there is a question as to whether or not 4% and above is actually sustainable. AT&T especially, their stock price has not been impressive, but their dividend has continued to increase, so we got a pretty high yield out of them. And you just go through the list, you take a look at all of these, and you can sort of get a feel for the type of rates that might be available from companies like this. And sometimes the higher percentages are the result of the company not doing so hot, so they don't want to reduce their dividend. They don't want to leave the Dividend Aristocrats, yet the valuation of the company continues to go down, so their yield actually goes up as a result of that. You can think if you're paying a large dividend on a stock that is worth less, well, that's a higher yield, but it's obviously harmful for the initial investors, the ones who got in earlier. And there are a lot of companies. You can go through this whole list. Now, the biggest criticism against dividend investing more often than not is that you can make more money using growth stocks. And if you're getting a higher return, it doesn't necessarily matter that you're getting paid dividends because you could just liquidate some of your position in order to get that cash that you need. The S&P 500 in particular has had a pretty good return for a while now. If we're to consider the last 10 years, they've had a return of 12.51%, which is quite good. Pretty consistently, year over year, they've increased. If we go to a longer term chart, we can see things like this. The 2008 housing crash, which really plunged the economy down. However, interestingly enough, even if you bought at the height of that market, if you just held through the crash, you would have made money a couple years later. Well, you would have broken even and then made money and then way more money. And there are concerns that bull runs like this can't continue forever, things like that. But generally speaking, the US GDP and economy has been doing pretty well. And when it comes to long-term investments, things like that, it's not an awful idea to have a fair bit of cash in here. And of course, this also does pay some dividends. It's not an impressive rate, but it's something. Also, I wanted to say that I deeply appreciate your viewership. And if you like this sort of content, I would really appreciate it if you like the video and subscribe to the channel. If you want constant notifications, just click the bell icon that pops up right after you click subscribe. Additionally, if you want to jump into the stock market with self-directed trading and get 2 free stocks to start off, a great way to start is with Webull. I have a link to Webull in the description below, and if you use that link, you will get 2 free stocks when you sign up. I'll have a little more about them at the very end of the video, or you can just jump in and read their terms and conditions. I highly recommend them, and I use them all the time. Thank you for your viewership. I really appreciate it. So there's a lot that goes into dividend investing. And when it comes to passive income, there's an interesting strategy that can really bump up the amount of money you get. 4% return, as we mentioned before, is not that impressive. Even when you consider the growth of those companies, some of those Dividend Aristocrats decline. But in general, an S&P 500 index is going to beat a dividend one, at least historically. Although there are a lot of ways you could have gotten around that. If you selected only winners for your dividend stocks, you would have made a good amount of money more than just the S&P 500. Because the S&P 500, while it does rebalance, it does contain some losers, and it suffers because of that. If you're better at picking stocks and you like to go for more dividend-focused stocks, you can make a good amount of money in passive income. But as a general rule of thumb, you have things like the 4% rule, which is pretty simple. They say you can add up all of your investments and withdraw 4% of the total during your first year of retirement. In subsequent years, you adjust the dollar amount you withdraw to account for inflation. Hopefully, you won't outlive your money during your 30-year retirement. Now, there are a couple things that change this, and obviously inflation plays a very big role into this, but this has been the traditional thinking, things like this, what you can live off of. So if you want to continue to grow an account, or get a certain amount to live off of, if you can get 4% dividends or yields, things like that, then you can effectively live off of an account without it losing monetary value, other than to inflation. And the strategy that really enhances this and that has really grown in popularity, especially as of late, is a covered call. Now, I'm going to assume that you know a bit about options. I'm going to go through some of the basics of how a covered call works and do a quick summary. But if you're completely lost about options, I have an entire series going over some of the basics, how they work, things like that. I'll have that linked in the description of this video as well as the title card. But essentially, an option is a contract. It is a contract that generally controls 100 shares of a stock. A call is simply a contract that allows the holder to purchase 100 shares of a stock at a specific price called the strike price at or before a specific date if it's an American style option. If it's a European style option, they can only execute it on the expiration date if they feel the need to. They get the option to buy or not. Now, there's a second type of options contract called a put, and a put does sort of the opposite. It gives the owner of that contract the right to sell 100 shares at the strike price at or before the end of the contract. Generally, you don't get options exercised early, but there are a couple things that could manipulate that. For the most part, they will only be exercised or expire worthless at the end of the contract, at their expiration date. Now, these contracts come into existence by someone writing them. This is known as writing or selling a contract. Essentially, you just make this contract, and because the contract controls a bunch of shares, you can sell the contract for money on the open market. And this is the profit loss diagram of a covered call. A covered call is simply the strategy of selling call contracts on stocks that you currently own, hence the term covered. If you were to sell just a naked call, remember that gives the owner the right to purchase 100 shares from you, since you're the one who wrote and sold the contract. So, since the owner has the right to purchase 100 shares from you, if you don't own the underlying asset, you technically have infinite risk. And the reason for that is quite simple. If a stock goes through the roof, it goes to the moon, it just flies up in value, well, then you need to get 100 shares in order to fulfill your end of the contract. And if you don't have 100 shares, then you need to go on the open market to purchase those shares. And there's no upper limit on a share price, so you have infinite risk possible. A covered call mitigates all this risk by you owning 100 shares of the underlying stock. And for every set of 100 shares you own, you can sell another contract. So here's the basic profit loss diagram of a covered call. When you sell your contract, you make money known as a premium. If the stock goes down or stays right below the strike price, stays around it as long as it's below the strike price at expiration, you make full profit. And the reason for that is if the contract doesn't hit the strike price, it's not in the money. It's essentially a worthless option since it would just make sense to go on the open market to buy or sell shares rather than to use this specialized contract because you're not getting them any cheaper or getting a better deal, which is why the strike price is so important. I'll go through an example pretty soon, but let's keep looking at this diagram real quick. Now, what if the price of the stock goes way through the roof? What is going to happen? Well, it's pretty simple. You're going to have to sell those 100 shares you own, which means if you made the strike price above what you purchased those shares at, you will make money selling those shares, and you will also make the premium, which means even if it goes past the strike price, there's a small window where you will continue to make money even if it goes past the strike price, because your cost basis, the amount you spent on those 100 shares, is different because you were selling premiums on them. So you need to account for things like that. But with a covered call, you'll see with your current price, you are actually limiting your maximum profit because you have to sell at a certain price. So really, if we just do the basic math, the maximum profit you could earn is the premium of selling the contract plus 100 shares at the strike price. So you're capping yourself. But if the stock stays below that strike price, you get to keep the premium and you can continue to sell options. Or if it just goes slightly past the strike price, you can just buy the stock at a lower cost basis if you really want it that badly again. And there are tons and tons of different assets for actually learning about covered calls. Ally Bank has a great little course on going through covered calls, what they are, things like that, if you still don't understand it. Tasty Trade also has a decent description. They have a lot of information on options contracts since that's sort of their specialty. And of course, Fidelity talks a lot about this and explains covered calls, things like that. They have a pretty long article detailing all of that. But let's go through an example so you understand a bit more. I'm using Options Profit Calculator, which is a fantastic online calculator if you want to understand options. It gives you great diagrams for profit loss. Let's say we're dealing with a stock like Apple. If we get the price, we can see what it was trading at, total number of shares, and we obviously need to consider the purchase price. Let's say we bought right here. Keep in mind, the more volatile a stock is, the greater tendency it has to go up or down, the more the options contracts are going to be worth, because the large swings in the stock price affect the derivatives like options way more. So if we select an option, this diagram will show up. We can select a different date. Let's go with the 23rd of July. And when we go to prices, we are obviously selling, so we want something outside of the money. Also, don't worry about these three numbers. Bid is just the bid. Ask is what the sellers are asking for, and mid is in between those. So whenever you have people making contracts and selling them, there are going to be some people who want to buy at a specific price, others who want to sell at a certain price, and then there's some middle ground. So we're just going to worry about the mid number, which is the average really, and what you'll probably be filled at, things like that. So let's go down here and let's see what we want to deal with. If we think Apple's recent bull run isn't going to continue, we could sell one that is in the money, or we could sell one just barely out of the money. Let's say $146. So if Apple stays flat or goes down, we will make money. Or if it goes past 146, but not a lot, we'll still make money because we get to keep that premium. So let's calculate this. You can see we get this diagram and it's really not that dramatic. If we extend it out and make it much larger, let's say we go to 155 and then we go to 130, we can calculate this out and we can see on the upper end, we are capped at how much money we can make. we can't make more than 2.26%. We cap that out if it goes up. Ideally, we want to be just below this so we can get the maximum amount of profit but not have to give up our shares, unless we intend to sell. But if it continues to go down, we can see that we're losing money, but not because of the actual options. We get to keep that premium, it's just we bought 100 shares at, say, this price, so we are technically losing account value if the 100 shares we have are declining in price. Now, if we change the purchase price, maybe we bought at 140, we can recalculate this and we can see a different chart. It's also important to take a look at the actual premium. The premium is the price per option multiplied by 100. We are making $234 just by selling contracts on the stocks that we're holding. And the yield on that is actually pretty good. Obviously, if we bought at 140, we would need $14,000 for 100 shares of Apple. But there are a little over 52 weeks in a year. If we're doing 2-year increments, let's say we can reasonably sell on 40 weeks and get around 230. Since this is a 2-week, that would be 20 times 230, which would be $4,600. Given our initial investment, assuming Apple does not go up at all and we can consistently sell those, that's a return of over 32%, which is really good considering we were sort of conservative with some of those numbers and we're assuming that Apple is not going to go up in price. That's all just fueled by options. Keep in mind, Apple also pays dividends. Not a huge yield, but that adds into the amount of money we're making. And you can see that very quickly. You can make a serious amount selling covered calls on stocks that you want to hold. Now, the main risk is, as mentioned before, you are capping your maximum profit, meaning you are missing out on those huge spikes if you end up having to actually sell your shares, and if you can't get back into the stock at a lower price. If this all seemed sort of complicated or confusing to you, there are ways you can make large yields without actually having to sell options. Because if you want to deal with options on a trading account, you normally need to have the account and experience for a little while, and you need to get different levels of options trading approved for your account. I have a video about this entire concept of covered call ETFs. I'll have it linked in the description of this video as well as in the title card of this video. But essentially, there are entire dedicated ETFs that do all of this for you. Granted, theirs are a little different. They own stocks for the NASDAQ 100 index, and then they sell call options on the index. And index options are a little different. So it's not 100% apples to apples, but it's incredibly similar. They're really doing all the covered call work for you and holding the assets, all of that. The largest and most popular one currently is QYLD, or QYLD. We can see from their page, they have a yield of almost 12%. Remember when we were going through the Dividend Aristocrat stocks? Remember all these where on the high end, some were touching 5%. We saw companies that weren't doing so hot, but refusing to lower their dividend. They were over 5%, things like that, but most of them were way lower. This is at almost 12%. And as funny as it sounds, there are also options available for QYLD. So if you own 100 shares of QYLD, you could go to their options chain. And on their options chain, you could sell covered calls on your covered call ETF if you really want to squeeze out a bit more percentage. And they do actually pay out dividends a lot more frequently than just 4 times a year. The only thing that's sort of rough about them is obviously sometimes their contracts get pulled. I mean, this is really most beneficial when the market is flat. Of course, you get lower volatility on the options they're selling, things like that. But if you're getting minor deviations in the market, things like that, then you can make a good amount with those returns. But it's obviously a bit volatile and a bit sensitive. We look at the 1-year graph currently. If we go to the longer term graph, it goes all the way to 2016, and we can take a look that over the long term, it has not been as well as the S&P 500 since 2016, right? If we look at 2016 for the 5-year, we have seen huge growth in SPY. Now, keep in mind, you are making a good return based off the percentage yield, far higher dividends in SPY, things like that. But there's a lot that goes into covered calls and a special degree of customization when you own your own assets, things like that. So really, I feel the best way to look at this is really a tool. If you want to jump into these, I would highly recommend you watch my video where I go through all the minutia and details of covered call ETFs. But you can see that covered calls are very popular and a lot of people find it appealing having consistent income. Personally, I've made a fair bit of money on covered calls, and you can obviously do them for cheaper stocks that you don't need $1,400 in. And the quick math we did before is if you can consistently knock these out of the park, it's not very difficult to get 30% returns on stocks that are trading flat. Now, the difficulty is not getting them executed at the right times and trying to play that balance of implied volatility for options price while not losing. So there's a lot that goes into it, and it can be a super useful tool for actually dealing with and progressing your financial future. And it is something to consider. I think they are pretty useful. I use covered calls all the time, especially if I'm down on an investment, but I'm not sure I want to quite sell out yet. I can help soften the blow by selling covered calls, things like that. And worst case scenario, I sell out of a position and make more money. So they're a useful tool. Don't underestimate them. But I do understand it can sort of be complicated and sometimes the topic can be dry. There obviously isn't a lot I can really do when just talking about options contracts, things like that. But I hope this video was informative. I hope it left a lot of good details for you. And I hope you're aware of this strategy and you sort of understand how these things work now, especially with passive income being so popular. I wish you all a fantastic time in the market. If you're interested in investing in the market with self-directed trading, a fantastic way to start is with Webull. If you sign up now using my referral link in the description of this video, you'll get 2 free stocks valued up to $2,300, which includes companies like Google, Facebook, and Starbucks, as well as many others. All the money in your account is yours to invest, trade, or withdraw as you please. It's your money. There's 0 fees associated with depositing money. You just get your stocks and you'll get your buying power immediately. So if you want a fantastic mobile, desktop, and web trading brokerage, just use the link in the description of this video. Thanks and happy trading.